Hello and welcome to How to Manage Risk, the channel for the governance professional, aspiring professional and the risk curious. If you enjoy the content, please like, comment, subscribe and share for more risk interviews as soon as they come out. Okay, so good morning, everybody, and welcome to Risk Management with Hawkins Hale. I am Emma Hawkins Hale, and my relevance really here is that I am an executive search and headhunting professional of many years' experience, and I work across the world with my lovely clients. So I'm delighted to welcome today's guest, Bernard Minsky, talking about, as I said, practical market risk management, not theory. And let me just give you a little bit of information about Bernard. So to start off with, he is the co-head of International Prime Service Risk for Marex Prime Services. Cowen, a US investment bank, founded the Prime Services business in 2016, and it was acquired by Marex in 2023. Bernard was a founding member of the Prime Services business, and he's got over 30 years experience as a risk manager in the financial services industry. So as I say, we are in extremely good hands today, guys. Bernard's worked for several asset management firms, including 8 years as the head of portfolio analysis and risk management at International Asset Management. So that's IAM, which is a fund of hedge funds manager. Bernard spent 10 years as an executive director at Goldman Sachs, running the risk functions for the firm-wide risk team, and also the prime brokerage in Europe. And prior to working for Goldman, he was a management consultant specializing in the use of quantitative methods in management and finance for over 20 years. Bernard is a chartered statistician, was an honorary reader in mathematics at the University of Sussex for 7 years, and has published papers and articles on risk management and portfolio construction. So as I said, we are really, really hitting the expert, one of the very best experts in this field. So thank you. And I know, Bernard, you don't pull your punches, do you? So should we get into it? Okay, so the first
Good idea.
So the first question I wanted to ask you is all around culture in this space, and the importance of culture when we're looking at practical market risk management.
Okay. Culture, I think, is the key and driver of all risk management, not only in our industry, but across all industries. I'm lucky that I have some friends who work in what I call real high intensity decision-making areas, including disasters and terror events. And I find their approach is, I'm going to say, more practical than simply a reporting approach and measurement approach that can be found in our industry. Uh, I think my own experience is it's really good to have an understanding of theory, but what you really want is a culture where everyone believes that not every dollar you earn is a good dollar, and therefore you should be very careful about what you're actually letting yourself in for. And sometimes it's a matter of being able to either sit on your hands or say no is important, and knowing that you have the support of senior management and being willing to go into bat with or against senior management if you have a strong view that something is not for you. I think the other part of culture, I think, is building teams that have trust. So everyone who is in the process is happy to rely and listen to the views of other people in the team. I'm very lucky in that the places I've worked have generally followed that, and Marex has a very strong culture of recognizing in our business not every dollar is a good dollar. And we talk about assets in a very peculiar way. We categorize them from the least risky being digestive biscuits and the most risky being nuclear fuel. And on occasion, we've had to point out that we do not need any nuclear fuel in our business. We're quite happy with a mixture of digestives and even chocolate cookies. They'll do us well.
Could I just
But
could I just ask at this point, just for obviously our listeners range in terms of their expertise, but if you could just perhaps just spend a moment giving us an idea of not who you're, not naming your clients clearly, but just giving us an idea of your sort of clients that you have at the firm.
okay. Uh, I've really worked around the hedge fund industry from both sides for the last nearly 30 years. Um, so I have been dealing with hedge funds, large and small, family offices, large and small, and sometimes we will be uh, an aggregation service to smaller prime brokers who then will be serving anyone that is building a portfolio and wants to use leverage.
Mhm.
So they want to use other people's money to build their portfolios. And our business is all about collateralized lending. So we try and convert the credit risk of the client into a market and liquidity risk of their collateral portfolio.
Brilliant.
So that's the sort of labor.
That's really helpful. So when you're talking about digestive biscuits, you're looking at the individual trades and the individual things as opposed to the nuclear
Yeah.
fuel.
We're talking about the difference between UST bills
Mm.
and a brand new cryptocurrency that's been issued last Wednesday.
Yeah.
I mean, that's the sort of spectrum. Um, Everything we would even consider has to be liquid to an extent, and we measure the amount of liquidity. It has to be tradable. It has to be uh, um, priceable, if you will. You have to be able to put a market price on it, and there has to be a market out there. So we tend not to be dealing particularly with bilateral sort of derivative contracts. We will do listed derivatives. That's the sort of mix that we have.
That's incredibly helpful. Thank you. And going back to the importance of culture. Sorry, apologies for my segue, everybody, but I was very interested, so I went off track a little bit. You talked about building trust and how important the trust is amongst the team. How, I mean, this is something I know of many, it's a long conversation, but just generally within your firm or where you've seen it work well building this trust, what sort of things help build that trust between the team members?
That's, I think very open communication is the first.
Right.
And this is from the top to the bottom. We have um, well, we're about to be four analysts in our team, but I don't just want to talk about the team I run. I'd much
Yeah.
rather say the teams I've built.
Yes, exactly.
Um,
That's what I meant.
ve-
Sorry.
Very, I've always been keen to bring on uh, newcomers to the industry, particularly graduates. Um, and I think it's a matter of being able to share your thinking. I think it's a matter of um, them having the confidence to talk to anyone in the organization, not to tell them, but to talk to them and to become aware. We have two co-heads of the whole business who any of my team can bring issues to. and they know they will get an audience. I do a lot of mentoring. I'm at the stage of my career where I co-head the division. I really cover from when my co-head is not available, but my roles tend to be on projects. My roles tend to be on mentoring, and it's wonderful when the team said, can you give me 5 minutes? Can you give me 10 minutes? And the conversations I try and have are, what do you think about this?
Mhm.
Or if I suggest something, say, why do you think I'm saying that? And get them to think. And I think that's how you build it in the junior team.
Mhm.
Uh, you have to be very careful who you choose to work for. And again, I would say at Marex, there is a lovely moment when the head of the business on the international side, who's one of the two co-heads, said, there was something you said in a meeting that I felt so good about, Bernie. I said, what's that? He said, I'm more risk averse than you. And I said, well, the reason for that is it was his business that he then sold. He is a man who, he knows that he wants every dollar, but he doesn't want a dollar that's going to bring the business down. And that's, the culture I will contrast it to where does culture go wrong? And it- it's very public that Credit Suisse failed because of Archegos. And you had poor communication in Credit Suisse, and you had the ability of the business side to exert more control than the risk. And the norm, I think the standard across the industry would be that if risk has an objection, that objection is the final word.
Yes.
And I don't think that happened in Credit Suisse. I also know that Credit Suisse allowed their businesses to be arbitraged. So if you couldn't get the uh, the leverage from the prime brokerage, you went to the swaps. And if you couldn't get it from the swaps, you tried the prime brokerage. It kind of reminds me of my grandchildren who, when mummy says no, they go to daddy. And when daddy says no, they go to mummy.
Certainly reflects
Um,
my own experience, yeah.
yeah. So uh, I, I think it's important that you have consistency and you have respect. Um, and you build those in by one, having a consistent view and having a strong view across all the business. So risk isn't just the worry of risk, but also growing the business isn't something that we ignore. We
Yeah.
look to facilitate the business, but we look to facilitate it without taking risks. And that's been the case when I was at Goldman, when I was at International Asset Management, and here. Uh, but I do feel that we've got a very, very strong culture in Marex, um, which is very pleasing, and it's probably why I'm still working at this age. It's uh,
And when we talk, can I just ask one more question? And this isn't something you and I discussed, but I'm very interested in um, behavioral science. I think you are as well. So looking at if you're looking at traders individually, or are there traits that are obvious when you meet a trader that they might be a little bit naughty and might push the envelope a little bit, or is it not obvious and you have to?
um, tri
Because you've got so much experience. So do you just tend to know
yeah,
their body language or whatever? Think, oh, I think you might be
I
naughty today.
yeah, I I think if you have a healthy skepticism, you do know. Um, when you say body language, sometimes if you're having a face-to-face meeting, you notice facial expressions, eye contact, lack of eye contact. That think, okay. Going back to when I worked for a very large investment bank, when I was at Goldman, I can remember a trader who tried to pull the wool over. It was not myself, but it was actually a product controller who was doing the P&L of an options desk, and uh, the the trader didn't know that this particular product controller had graduated from Bristol in financial risk management. So the conversation started with the trader saying whether these two gentlemen, Mr. Black and Mr. Scholes, and I could just see the product controller's eyes rolling because he said, "Are you going to tell me that we price options with the Black-Scholes model? You're obviously trying to kid me about something."
Yeah.
And you know, if you if you were to track this particular trader's career, he's often been in awkward situations. Um, and you know, I think it is, that is a very simple behavioral thing. You know when someone's trying to pull the wool over your eyes. But I think it also touches on something different, which is when I worked in a central risk department, and we were charged with verifying the pricing of complex structures, including complex derivatives. Um, when you thought about the risk actually that would be taken, even with these structures, it did boil down to the fact that it was going to do one of very few things to you. It was either going to expose you to the market and directionally uh, in a way that maybe you hadn't spotted, or it was incredibly levered. So if things did go against you, they went against you very quickly. Or it was one of very few things in the portfolio. So if it did go wrong, it could blow up the whole book because it was such a large part of it. So it was really down to directionality, leverage, and concentration.
Mhm.
And overlaying it was whether or not there was any liquidity.
Mhm.
And what what you often found is the more people talked about the complexity, you would question, do they actually really know what they've got in there anyway?
Interesting, yeah.
And secondly, something that became an axiom for me and for many of my colleagues is if you don't understand it, you're not going to touch it. And we were very willing, um, wherever I worked, to say that's not for us. And not because it's not a good product or whatever, but I don't think I could price it.
Mm.
I'm not that skilled at that particular part of product pricing. I mean, I could probably hammer out something if I were forced to, but I'm not so sure I'd be very happy with running it. And um, time and again, admitting that you were not that clever was the best thing that I ever did,
Mm.
and my colleagues the same.
Mm.
um, because you would hear statements like this is like permanent finance, and I remember walking out of a meeting. I don't really understand this, but that permanent finance is permanent until it goes wrong. And of course, this was actually CDOs. Someone was telling us that you could finance your portfolio using a CDO. and that that you would never be under stress. And
Oh,
this was when I worked in the fund of hedge funds, and we walked out and we said, "Yep," until the markets go bad. And we just walked away and we said, "Thank you, but that's not for us." And it's not that we're very smart, but it's that we were willing to admit that we're not very smart. And that's a hell of an asset, having a bit of humility.
like the emperor's new clothes, then almost. You don't really, you sort of go like the emperor's new clothes. You could go, actually, that all sounds a bit, thanks very much, but it's not for us. You just walk away if it's
Yep,
created into,
yep,
it makes total sense. And obviously
yeah.
very, very wise. Shall we move on to the next area of interest, which is basically talking about the limits of quant when you're dealing within market risk situations. What can it do? What can it not do? How useful is it and isn't it? And obviously you're a chartered statistician, so I'm going to ask you all about
Yeah, I feel like I'm betraying the tribe.
that.
Uh, um, Particularly the advent of quantitative risk, value at risk and variance of it, was a sea change. And let's talk about the positives. It was the first time that we were really able to take a single view across asset classes of risk. And we recognized risk as being volatility effectively. Um, and we also recognize the importance of diversification and correlation, and uh, it really did allow you to take a view of the whole portfolio, a sort of holistic view. Um, Unfortunately, every model is a toy or a simplification of reality. Um, and the assumptions to varying extents are dependent on uh, history repeating itself, uh, the stationarity, uh, having a full understanding, and really saying that you understand the probability.
Mhm.
Um, My concerns come in that statement. And I think Colin Lawrence spoke on one of your podcasts beautifully and said, why are we talking about risk? We should talk about uncertainty. And I think this is very true. Um, we we've had lots of examples of issues where people have said, we've had a 1 in 1,000 year event every day this month, and we're on the 25th of the month. So it's a bit worrying. But this kind of indicating some of the assumptions obviously were not true or had broken down or had changed. And there's the real prospect that you are working with imperfect data. We're always working with imperfect data, but if you bet your life on that, good luck, is my view. Um, I do, I do spend a lot of my time worrying about very extreme events. And this is where the data is thinnest, information is least, and um, judgment is most important. I mean, very often, what I think we're trying to do is not overexpose ourselves should an extreme, very unlikely, but disastrous event occur.
Yeah.
Particularly when you're in the prime broking business, because you're the second line of loser. The investors, unfortunately, will lose well before the prime broker who's provided finance will lose. Um, it's just a function of how it is. It's rather like debt holders naturally lose after the equity holders, and that's what we're talking about here. The investors are the equity holders, and the prime broker is the debt holder. So we are later in the failure list than the investors.
Yeah.
Um, but we know that you can jump right to the top of the pile if an extreme event occurs. Um, so that area is one where quant is methods are stretched. We use quant. I've used it. I think if you are comparing portfolios or comparing the same portfolio through time, and you see the quant risk numbers going up or going down, that is telling you something very meaningful. And you know that the more risky portfolio, according to your quant measures, is almost definitely the more risky portfolio from a practical viewpoint. And you would look at that. I mean, one reason it may be more risky is it may be more concentrated. And if it's more concentrated, the risk of one or two positions blowing up a portfolio is greater. So you have to think about that. But very often it's down to looking at what you get from the quant. Running stress tests is something that we believe in. To what if the world turned on its head? What if markets fell 40%? Or what if the AI boom busts as the dot-com boom did? What would happen? And if you've got a portfolio that is full of Nvidia, AMD, I know, probably even Meta and Google and everyone else in the technology, they're going to be hammered.
Mm.
So, that is, and if that were to blow, that will go very quickly. So that's the sort of thing you don't want to find yourself sitting there overexposed. Um, Nor do you want to find yourself short to meme stocks when 2021 occurred. Um, if- so it is combining using quant, and we have to measure is very important, but actually being slightly skeptical and standing back and thinking about what you want. Um, and I guess it comes back to my good dollar v bad dollar view of the world. So uh,
That
often the simplest measures.
and that brings me actually something that I wanted to ask you, and I don't know whether this is relevant to this particular topic. The limits of quantum dealing at the extreme ends. One of the things I do headhunt sometimes for the hedge funds, as you know, I have done it for a while, for a long time. When I look at the hedge funds these days, and I don't know if this is just my impression, in the old days, you'd have your very much your rock star traders. And I'm seeing fewer of those people. I don't know if that's true. People seem to get more uncomfortable, or hedge funds or firms are more uncomfortable with potentially people with those outlying statistics. Would you say that's correct? Or do you think that's just my take on it at the moment, and that's not correct? I wasn't sure whether the hedge funds have changed their profile of the risk that they're taking. And I wondered, with you obviously in your position on the other side, do you think what do you think? Do you think the composition of how they're trading has changed in terms of the risks that
Um, I
is
think
that
we
too much or
still have a world in which you have the the great portfolio managers, traders, the stock pickers, uh, the qualitative managers.
Mm,
Um, it was very interesting. The headlines last week or the week before about Isla Capital closing
mm,
and saying the competition for talent is too great. Now, Isla himself is a rock star name. I remember him 25 years ago at Goldman, and he got to be very senior there. Um, you, you know, uh, um, you've seen it actually even in outside of um, hedge funds in traditional managers, certain managers who were rock stars falling from grace, Neil Woodward's, um, where you actually are probably hitting on the hubris versus humility, and I think generally fund management is worrying about hubris. It's worrying about people who are so sure.
That makes
And
complete
the
sense.
rock stars also might bring you overconfidence, and I think that is a worry. I mean, that anecdotally, I can go back 20 years and remember my boss speaking to a very successful hedge fund about our margin risk policy and their risk management. And in the guys in the hedge fund said, if you were so smart, you'd be working for us. To
Mhm.
a guy who I thought was one of the cleverest people I've ever worked with. Um, and he kind of took it on the chin. 2.5 years later, they were one of the biggest blow-ups in hedge funds because their super risk management missed something very obvious, and they were over concentrated it with a star trader who blew up.
Yeah, so that's fascinating, and thank you very much for that. Because one of the things I've noticed is uh, exactly as I said, if I'm speaking to certain funds about certain people, that there does seem to be sometimes if their performance is their outperformance, and you have the trading record for it, at a certain level, the funds can sometimes become uncomfortable with it. And I wasn't sure whether, although they potentially love to have X individual, there are questions raised, how have they managed to do this? Or yes, they do this, but then what's the downside performance, which I completely understand. But well, that's why I was asking about the quant at your area of the industry, where, as you said, you're dealing at the extreme end. Does it then, do people prefer things to be slightly more in a normalized band because it makes it easier for them to understand?
Well, yeah, I mean, we would always be looking at the construction of the portfolio, what's in the portfolio. Um, so is it a star manager? Or is it there's a style. The guy that wants to go really concentrated, or a lady that wants to go really concentrated, is not the sort of portfolio we like.
Mm.
Um, I, I guess in a professional capacity, you're not really judging the manager per se, but you're judging their strategy. And I think investors have been accused of fear and greed. We all have in the
Really?
industry,
Yeah.
fear and greed. So um, when it's going up at 80% per annum, that's something I want a share of. But why is it going up at 80% per annum? Could it
Yeah.
fall back? And when it does, how could you do this to me? And I've actually heard traders say when they've had say a particularly build up a position, this, um, the reason this is all going wrong is the market has got it in for me, so they're all trading against me. And he may have been in a very large fund or a very large bank, um, but all I can say there is if the market knows you are really exposed, If other traders do know that you're very exposed to something and they don't believe in it, they will trade against you. I've seen it with hedge funds. I've seen a hedge fund that put on a pairs trade in enormous size and highly levered, very highly levered. Uh, and it was literally what appeared to be a well-hedged pair because there was a sort of holding company versus operating company type situation. Um, but the market view on the two stocks was such that they were not actually going to converge, or at least in the short term. And you know, you need to have an awfully large reserve to keep holding a position
Yeah.
when the market's going against you. You know, the guys that made it big in 2008 by shorting the subprimes and credit, the credit crash went through a very, very tough time of trying to keep their investors on board when their positions were losing money because there was an exuberant rise in the market, even as it was doing the wrong thing, so to speak, and lending precipitously and unwisely. So, you know, you see they won in the end, but they had the ability to stay the course. But it's very, very difficult. Um, those that were on the other side of the trade even knew that it was a bad trade. So the head of City said, "What was it? We all know it's going to be terrible when the music stops, but while it's playing, we're still dancing." Yeah, that was, you know, and that didn't end very well either for him or for the industry.
Mhm.
So it is, star traders might be one way of putting it. I just think it's silly. It's taking on risk that or taking on positions that could blow you out of the water. And
Yeah.
again, I come back to my three drivers: direction, concentration, and leverage. If you mix those up, and you haven't got the liquidity to get out when you need to without taking big losses, it's probably if between now and when,
Yeah.
and you become a hero if you get out before when arrives. But as a risk manager, you just don't want to be part of that game.
Mm.
And that's the sort of practical thing that we're dealing with. We just try and make sure we don't, we're not playing in a game that will really submerge us, take the business down.
Mm.
Um, other than that, you're just watching for sensible management. Personally, I have a theory that one day I'm going to make a dreadful mistake. I think everyone will in their lives, sort of.
I'm
And
touching
I,
wood. I'm looking for wood. May it never happen. There we go.
yeah, yeah. Well, my hope is that in the risk management context, it really is something that hadn't been seen before. I would be very bothered if we actually made the same mistake that others had made in the past and hadn't learned from it.
Yeah, and
You know,
that brings me beautifully on to my final question. And thank you so much for the time you've already spent with us. You've been very generous with your time. Why do the same mistakes occur in market risk management all the time? What's going on? What's happening? Tell me.
we've kind of been talking about that.
Yeah, we have.
A
Um,
lot of it is about, I think, people thinking that they know better,
Yeah.
and who really is sort of hubris. Um, and if I'm up 80% so far in my hedge fund, and I'm going up another 80, and you know, I understand the oil market, but what if the behavior of the oil market changes? There have been hedge funds that have ridden the rise in energy prices over certain periods, and then when it became choppy, they just got whipsawed,
Mm.
didn't understand it, or people that were in the credit trades. Um, that after the event, when they had put on a particularly large concentration in a highly illiquid, specialized uh, uh, trade on, let's say, one of the main credit indices, um, they found themselves, uh, uh, after the event, justifying why it had all gone wrong and saying, oh, well, the assumption that I made about default rates on AAA bonds, they obviously changed it. And actually, no, you were in bilateral trade where you had given up any flexibility to trade out or get pricing outside of your counterparty,
Yeah.
and they squeezed you because they could. And so it's a sometimes it's a lack of self-awareness, I think, or actually arrogance. So people who run a hedge fund go bust, start up again, and the investors come back. And I don't think it's really the manager's fault, but you sort of wonder about the investors. Why would you? It may well do very well, but if it goes wrong, you know, who are you going to blame? You, you um, the, this sounds a very, very bad an analogy, but they always say that, to commit your first crime is a very, very high bar. The fears of either going against your conscience or that you might be caught or whatever. But if you get away with it, why not have another go? And you know, the cliche of fool me once, shame on you, fool me twice, shame on me. I think, well, as a hedge fund manager, I haven't had to pay back all the performance fees when I took you up 200%. Unfortunately, we ended up down 50 in when we shuttered. Um, I wonder if I could do that again. And I, I, I think, if you've got that much confidence, you probably do think, well, I made a mistake, then I won't do it again. Um, but the same things work, and you get into another bull market, and off you go.
Yeah.
Um, and if it goes wrong, it doesn't seem me that pays for it. Um, it's not even as if you get, I was going to say it's not even as if you get cast out by society. You know, the principle of archegos had been disciplined by the regulators, and yet people were invested.
Goodness me.
Um, there are other cases of hedge fund managers that moved to different domiciles because they were declared unfit to manage a fund in one domicile, but were allowed to set up elsewhere. And whether or not the judgment that they were unfit was fair or not, I don't know. Um, but if you're an investor, and we had these sort of questions asked to us at IAM, um, you know, you're probably safer saying no, even if you're missing a golden opportunity.
Yeah.
Because if it goes wrong, As a fund of hedge funds, your investors are going to blame you. Say, you know, the yet you knew this person was regarded as unfit by this regulatory authority.
They're simply not
It's
perfect.
always a classic, it's the Daily Mail test. If if what you did were reported in the Daily Mail and you appeared an idiot, you shouldn't do it. That perhaps is a risk management tool.
Yeah.
Um, in America, they say if it's in the Daily News, if you get written up in the Daily News, um, would you like it? And the most innocent things can be construed in awkward ways. So it may have been a sensible decision, but with hindsight, that reporting would do, it appears incredibly stupid. And if you can in your mind see that daily news story, it's telling you that you are increasing your reputational risk by doing this. So you probably don't want to do it. Yeah. That's but then that's a sort of a conservative risk manager speaking.
No, it's absolutely fine.
But I do think a lot of it is down to arrogance, which leads to hubris, and I think it's down to greed.
Mm.
Where people will invest because they remember the good times, the upside, and they will assume it won't happen again. But history does kind of repeat or rhyme,
Yeah,
seems to me.
yeah, absolutely. Absolutely. Thank you. Well, thank you very, very much for joining us today. It's been absolutely wonderful. And I really enjoyed the
Um,
conversation. And I hope everybody else, I'm sure everybody else will have done too. I will, if anybody would like to reach out to Bernard, do please send me a message. It's fine. And we'll see what we can do. But in the meantime, thank you so, so very much for your time. It's been absolutely excellent. And I don't know, I've learned so much. So thank you. Really, really.
Well, I've really enjoyed it, and I hope it is useful, and I hope people gain something from it. I always want to give back something.
Yeah.